Right, volatility. Volatility is what day traders dream about. This is where they make and lose lots of money. But it's also where short-term to medium-term traders often misstep or get stopped out prematurely because they tend to trade volatile stocks and they're not sure where to place their stop loss. So if you took a stock like NASPAS, for example, and you went long a couple of days ago, you would have enjoyed a 60 Rand move, but then a day later you would have probably not enjoyed a 35 to 40 Rand drop on that stock, and you probably would have been stopped out if you had a stop loss that was too tight. And too tight is probably understating what I'm trying to say, because on a stock that's volatile, how would you know where to place your stop loss? And can you handle the big price moves? So a lot of traders often think, well, I'm going to put my stop loss 30 Rand away on a stock like NASPAS, where 30 Rand actually means nothing to that stock, and you would have stopped out for no reason, only to find that stock jump up another 40 Rand again a couple of days later. So volatility is one of the main contributing factors for stopping out too early. Short-term traders rely on volatility to make money so that they're able to scalp small price moves. It makes sense then that having a stop loss on a very volatile security that has big swings makes no sense at all. So you need to have guts and you need to identify the volatile stocks. And I've got a little thing that I want to show you now just to help you out on how to identify volatile stocks. A nice indicator, if you guys have got a charting package or software, it's a very nice indicator to add to your technical analysis. You use the Bollinger Band. So having evolved from the concept of trading bands, Bollinger Bands can be used to measure the highness or lowness of a price relative to previous price action. Okay, so all this really means is it takes all the highs and puts a band at the average high price, and it takes all the lows and it puts a band near all the low prices so that you got an average. It also has a line right down the middle, and it's generally a 21-day moving average. Okay, and how to read a Bollinger Band, but I will show you, but an explanation is, when the bands lie close together, you have a period of low volatility. Okay, when the bands expand and they get further apart, there's an increase in price action, and market volatility is what is being indicated. So the further away these bands get from each other, the more volatile it means that share price or that security price has become. Okay, so when bands only have a slight slope and track approximately parallel, and parallel doesn't have to be a straight line, I'll show you on the chart in a bit, it means that there's a period of normalcy or normal trading, and you could probably end up trading ranges or trading the channel. Okay, but let's have a simple look at Bollinger Bands. This is just a nice visual on the Dow Jones, and this shows you kind of what Bollinger Bands are supposed to do for you. So in the middle here, you generally have your 21-day moving average, and prices tend towards and away from it. Okay, so here the upper band measures all the highs. As you can see, the highs always tend to go towards the higher band, and the lower band kind of measures all the lows, is what I was telling you about. And the midpoint over here generally should be where the price is trading. Okay, now how to read this. So let's start from high volatility. Here you can see the big difference in the space between the upper and the lower Bollinger Band. Okay, this tells you quite easily how volatile this period of trading was. Okay, and a lot of traders would be stopped out in a period like this unless they've got the guts to stay in and realize that there is volatility and they need to stick it out. Okay, most guys like to, or the more cautious trader would like to trade in periods of low volatility. So the Bollinger Band gives you a nice visual to get in and out of trades. You typically like to get in the midpoint, trade up to the top band. If it goes to the bottom band, you stop out. Or if you had gone short on this trade, you'd have taken profit here, stopped out on the top band. Nice and easy to trade. But then you can see it started widening again. The price kind of stayed stagnant for a while, then the volatility started kicking in until we went to a medium volatility. And remember I said medium volatility is where the Bollinger Bands kind of parallel track each other. So instead of bulging out like this, they start to form a bit of a track or a train track that becomes nice and easy to trade. So you can even see the direction over here is sloping down. So whenever the price touches the top Bollinger Band, you could probably look at placing a short trade and waiting for it to either get to the midpoint to take profit or wait for it to retest, if you're really greedy, retest the bottom Bollinger Band to maximize your profits, but very easy to place a stop loss just outside the Bollinger Band. Okay, so any charting package should give you the ability to place Bollinger Bands. A lot of traders use them successfully, and a very nice indicator of how volatile a stock is. Now, if we are trading NASPAS, for example, these bands would be bulging like this everywhere. So you need to identify volatility, identify low volatility, identify medium volatility, and trade within that so that you don't stop out for no reason.